Okay. Hello, good morning, everyone. We are back with a social market housing review. Today we're going to be starting with Alex Rose from Zoopla. Alex is going to be giving us a lot of key information on data in terms of what's changed in the market since we were last with you. We'll then be moving on to Greg Warner-Harris, and Greg Warner-Harris will be giving us an independent consultant's view on what the market is doing right now. After that, we will be going straight to Becky Utuka, who is the Development of Director in Sales for Gateway Housing Association, who will be giving us her report on how she is dealing with the current market. So hopefully we'll have a really nice, robust, comprehensive view from three very different opinions on the market. And hopefully we'll also be inviting more Q&A and engagement afterwards. So if you're in the audience and you'd like to jump on the call, this is your 40-minute warning. I will be asking people to join us at the very end. Okay, so before we begin, I just want to put out a couple of messages. We work quite hard upon these webinars, and actually we have a bit of an unsung hero here, and her name is Sheila McCluskey Carroll. Now, Sheila actually did a lot of great work for the company, she did seminars, the physical seminars, which a lot of people still talk about, and paved the way for all the work we're doing today. Sheila is very keen to talk to a lot of you. She knows a huge amount about development and knows our systems inside out and is currently training on them. So if you'd like to join our panel, if you'd like to talk about things that you think that we can do webinars on, then please do reach out to Sheila. You can email her, or you can get in touch with us and we can put you in touch with Sheila. Sheila's a great person and she has the voice of a nightingale, so I am sure anyone would quite enjoy a conversation with Sheila. Next thing. Come on, slide 2. Okay, here we go. So I'm going to put our chat links in the comments for myself and my colleague Ricky. We both quite enjoy talking to our customers and being more in tune with our customers. So if you want to talk about anything from additional licenses to further training, or just trying to understand the product and use it a bit better, or maybe even try and explore another product, myself and Ricky are the people to talk to. So I'm just going to link our Calendly. This is just a link. You can book a quick 30-minute chat with either of us, and we sincerely hope to hear from you. Right, okay. Without much further ado, I will now hand over to Alex Rose. Alex, welcome.
Good morning. Thanks for the intro, Christopher, and hi everyone. Nice to see you this morning. I'm going to share my screen with you all, and I'm not a proficient Zoom user. I'm more of a Google Hangouts kind of person, but if I could get a thumbs up or a yes, you can see that.
Yes.
Brilliant, thank you. And I'll just go to full screen mode. Great. So I'm just going to cover with you this morning in the session Zoopla's view on what we've seen happen, I guess, since the inception of the pandemic, if we cast our minds back to March 2020, but more importantly, what's the impact been since the market reopened last year, and how do we see that evolving into 2022? We run a number of businesses and subsidiaries across the Zoopla business. Businesses such as HomeTrack, who work a lot in the public sector markets, but also with the retail banks in mortgage lending. We obviously have demand side data on the Zoopla website, and we also have a lot of consumer data via our USwitch brand. So we've pulled together the richest, most informative data for you for this presentation, and I'll run you through it. And I believe that the SDS team have got a copy of this, so it will also be shared. So don't feel like you've got to scribble down and take lots of screenshots. Sit back and relax and enjoy. So how do we move on a slide? There we go. So most importantly, I think is, since the market reopened, and if you sort of see in that orange line, it was mid-May last year, housing demand just really shot up overnight. You could argue to begin with, it was latent demand. If we cast the mind back to spring last year, we weren't able to move home, we weren't able to view properties. It was a very challenging time during that first lockdown. Once the market reopened, we saw firstly that latent demand come in. And then secondly, we had the impacts of a twofold impact. One was the economic support that we were getting, either via the stamp duty holiday or the furlough schemes and measures that the government took to support employment. And secondly, we also saw, and perhaps none of us really saw this coming at the time, which was the impact of just a large-scale reassessment of our housing needs. And that actually triggered more home moves than we expected at the time, and from a slightly different demographic. Today, we find ourselves, if we look at October 2021, in purple, we can actually see that housing demand sits 30% above the longer run average. So demand today is still 30% above the 2017 to 19 levels. And I just touched on the large scale reassessment and what was that change, and I particularly here draw your eye to this sort of purple line where if we look at the demographic categories of home movers, we actually saw quite a large influx of home moves from what would be classed as the affluent achiever category. And from demographic terms, that's typically people either in what we call mature money, so they've built up equity in their homes, or in high income brackets. So for those people in that category, they had the luxury, if you like, of being able to move home last year, take advantage of the stamp duty, perhaps have the biggest savings because of the way the stamp duty was tiered as well. And so there was a reassessment in that category. What that did do was put some pressure on the financially stretched, and those that perhaps felt the economic impact of COVID more. We actually saw under index on home moves during that period. But the good news is that you can see that both lines have started to converge back towards the long run average. So, with some kind of rising indicators in the economy and in employment, we're seeing those kind of more affluently stretched categories moving back to the long run index of home moves. In terms of the long run average on sales transactions, this year we'll probably hit around 1.5 million transactions in total. If you look at last year, which was the last purple line on the right, we dipped below the long run average of 1.2 million and achieved around 1 million sales. So last year there were 200,000 fewer transactions than we would have expected. You could argue that that's added on to this year. So we've seen those transactions come through in 21, and we've also probably seen around an extra 100,000 transactions that we wouldn't have anticipated pre-COVID. And I think that's where you can see in that kind of affluent demographic of home movers that wouldn't have historically moved. There's also another issue coming at the moment, which is the scarcity of homes available to buy. This is just looking at the number of homes that each estate agent on Zoopla right now has to advertise. And the long run average would be an average estate agent high street branch would have 25 to 30 homes for sale at any one time over the last 5 years. Right here, right now, that average is almost halved to 15. So if you are out in the market at the moment as a consumer, there's a challenge because there's a lack of stock available on the high street for estate agents. And in the new build market, as we'll all know, a lot of house builders have been forward sold, a lot of outright sales. There's high demand, obviously, on the shared ownership product right now. So all in all, demand is outstripping supply right now, which creates some upward issues on pricing. Looking at time to sell, which is a really interesting metric for us, you can see that in all parts of the United Kingdom at the moment, we're running well below the 5-year average. So in Scotland, it's as extreme as 14 days as the average time for a property to be listed on Zoopla to being marked as sold subject to contract. And in most parts of England and Wales, we're running at 20 to 30 days. London being the only exception at the moment that's running around 50 days. And we're finding, due to partly the reduction of demand in London, with a lot of people choosing to perhaps move out of the London market, we're seeing that's impacted a little bit more. We're starting to see those indicators for London come back a bit as more people return to work in the city, and tourism also starts to appear for the first time in 18 months. People are talking a lot at the moment about house prices, and we're seeing the greatest increases in house prices happen at the moment in the most affordable markets. So what I mean by that is, if you look at the right-hand side map, the red hot spots are areas where house price to earnings ratio is as high as 10 times, so 10 times the average income to buy a property in those areas. Through to the green areas, if we look at Wales and the north of England, at around about 4 times the average income to purchase a home. And so it's no real surprise that in those more affordable markets, where people have perhaps the financial freedom in the last 12 to 18 months, but also I guess the employment freedom to look at moving further away from their place of work, people are choosing to price in on lower value markets where they can buy a bit more for their mortgage and their affordability. And we've also been doing some surveys at the moment of our consumers, just asking them, how's COVID shaped their views and their position over the next 2 years on the housing market. And interestingly, 22% of people said that they're now more eager to move than they were pre-COVID. So again, there's a changing attitude. 60% say it's not changed their attitude. They're kind of staying as is. And 6% less eager. And I think, we have to think about the 6%, particularly in the affordable markets, because I imagine it's, very much driven by their economic situation impacting their ability to move and their willingness to move, rather than any other metrics. So important to see the market kind of end to end on those spectrums. But also, what is driving that eagerness to move? And I think we like to talk a lot about work-related factors and more working from home and flexibility. But interestingly, consumers are telling us that the biggest impact on wanting to move is more about the space and flexibility afforded within their home. Outdoor space has featured really highly as a search term. A lot of people, mandating that as something they need from their next property. Bigger homes are being, people are aspiring for larger homes as they need more flexibility within their home to use an additional bedroom as perhaps a home office, or areas where their children can be at home more as well. And also, as I say, that garden and outdoor space. So they seem to be featuring the highest in terms of people's attributes and their focus on what they'd like to move into next. And looking ahead to 2022, a bit of a SWOT analysis here of what we see the opportunities and challenges really into next year. I guess if you've got a build program, the scarcity of housing supply right now can play to the strengths of that build program, because any nervousness about the viability and feasibility of that program, we're certainly seeing in our indicators that there is plenty of demand within that. Of course, a weakness of that build program right now could be the inflationary costs of materials and labour shortages as well. So I realise it's not as easy as one for one, house prices increasing, but you've also got to find an increasing cost base and neutralise that in some way. In terms of strengths as well, just the ongoing demand and also the sales volumes, we're not seeing a huge or material change in those sales volumes at the moment. So, that's obviously strong. And the affordability of homes, whilst we like to talk a lot about the challenges in affordability, generally speaking, cross country, the affordability in terms of the long run average seems to be in line with the macro indicators. In terms of opportunities, there does seem to be some supportive government policies remaining in place, not just in housing, and we'll obviously wait to see what our new housing minister says and comes out with bated breath over the next 6 months or so, but also just economically, there have been supportive measures that have supported the economy and wages, which have meant that we don't have a knock-on effect to housing demand. But also, opportunities. I think a big thing that consumers are driving towards is the climate agenda and energy efficiency of new build, and particularly in the older demographics. Interestingly, there's a big. We were doing a study yesterday looking at empty nesters and how actually one of the biggest USPs of a new build for them is the energy efficiency, I guess, particularly with the energy crisis that we've got going on at the moment. Weaknesses, as I've talked about, the affordability of an average priced home, but clearly if you've got to potentially build a new build or sell within a Section 106, that can mean that the properties are still relatively expensive, particularly in southern England and London, where there's still challenges for people to get on the ladder. And longer term threats of course, inflation rate is about to hit probably 5% in the next few quarters or months, and how will the Bank of England react to that? And clearly taxation as well, and some noises coming out of the Conservative conference this week around changes to taxation and regulation. So watch this space, but certainly a really interesting market ahead for 2022. In short, we're confident that demand is there and that will remain in place in the long run. Clearly, the challenges will be in your cost bases and what government support and macroeconomic pressures start to come into play. As I said, we will share this with you, but my contact details are there for you on the screen as well. So I'm always happy if we don't get to answer any questions today or all the questions, I'm always happy for you to reach out if there's something you'd like to chat to me about. Thank you very much.
Thank you, Alex. That was great, very comprehensive. And now, welcome, Andrew. You're joining us. You joined as a panel and as an attendee, and then I had to promote you. Welcome, Andrew. We just want a quick little introduction here for those of you who don't know Andrew. Andrew is Andrew. I'll let you introduce yourself.
Well, hi, I'm Andrew Markham. I head up the new business team at SDS and our consultancy team. And I have been here, I've just been in the background listening very avidly what Ross was saying. Alex was saying. Very interesting.
Excellent, brilliant. Well, we will now move on to Greg Warner-Harris. Greg, if you'd like to share your screen and take us through the no doubt excellent tidbits you have prepared.
Okay, excellent. I'm not sure about that, but yeah, thanks very much for the introduction there. And actually, it's really useful to be following Alex, because Alex has done a really good job for me in setting some of the scene of some of the nuances I want to talk about. Because what I am to talk about is the nuances of the pandemic market in the concept of a marketeer, what we need to do and what we need to be aware of. Some of you may remember we had a webinar. It was right at the kickoff of the pandemic, I think just shortly after lockdown, sort of April 2020. I can't believe it's that long ago, but it was. And at the time, we saw it in Alex's graph, the market was going down, and we were speculating. And I think there was a consensus that, yeah, the house market would recover, because it always does. And there was some debate on what that recovery would look like. And there was two real consensus. One view was that, I think the most common view, it would be a U-shaped recovery. The market was dropping, but it would plateau out at the bottom, and then eventually it would come back up again. I had a slightly different view. I wasn't alone, but my view was it would be more of a V-shaped recovery. And the reason I thought that was because I actually lived through the 2007 property crash, known as the Lehman's crash. The actual property market started going down just before Lehman's did. And that was a long downturn in the market. But there was a structural issue in the market there. There was structural issue with banks, there was poor lending, a whole bunch of stuff going on there. Whereas this is just essentially a public health matter. And so I didn't think there was going to be any structural reasons to keep that market down. We did have another view as well, a single view, a bit of a sort of a left field view, and I'll come back to that. So I'm going to share my screen if I can. Here we go. Right, is that sharing? Is that sharing, guys?
Yes, it is.
Thank you. Right, okay. So what I want to do, I've pulled out some data, and what I've used is some data from HMRC, and when it comes to the softer issues like confidence and market resilience, for marketeers are looking at what they can get out of this. I pull out HMRC as opposed to Land Registry because of the way they distill and create the data. And so here's a very, very sort of rough view on what happened in terms of sales. And these are the number of sales. And the blue line is the sales. The red line is just an offset trend line. So it's basically trying to show the shape of that curve, because as marketeers, we want to get underneath some of the things that are going on here. But it's not actual values. So we saw the market crash down here. This is when actually lockdown happened in March, and we had our seminar round about then. And then it started to recover pretty quick. Here we've got the post-January bounce. We see that in the market in any case, and we've got another spike here. We all know what that's about, and we'll come to that in a minute. But what I want to do is just overlay onto that, or compare against that, another line. Now the black line is the same number of months, March through to August, but this is 18-19 as opposed to 2021. And the reason I've done that was really twofold. What I want to do is to look at actual numbers, and again, it's echoing what Alex pointed out. Actually, we're doing better than we did in a pre-pandemic market. We've got about 1.89 million sales transactions as opposed to 1.78. So in a global pandemic, everyone on furlough, turmoil in the world, actually there's more sales happening. Okay, we've got the dip down there, but it recovered. The other thing is, if we look at this peak here, from here onwards, the curve is roughly the shape of what we saw pre-pandemic. We've got a little blip here. It's more exaggeration here, and I just think that was the pent-up demand. There's a sharp stop just before Christmas, and then the work gets completed afterwards. So in that respect, you know, the shape of the market isn't that different from here to here than in, you know, normal times. It's recovered from this little dip here, and it's made up for it. The area under that curve is roughly equivalent to that. So why is that then? Let's have a look at that spike here. We know what that's all about. This is the this is when the tax relief, the stamp duty relief was put in place, and here is when it did come off but started to taper down. There's two things as a marketer I want to look at here, because I want to know that when there's hiccups in the market, is there anything I can do? What mitigations can I put in place to help the sales team sell their products? Now this here is obviously that's a timing issue. You can see the area of the two triangles underneath that dissect there. It's roughly the same. That is all about people getting their sales done before the end of the stamp duty relief. There's tapering, of course, and we can't see what's going to happen here, but I suspect this is at the stamp duty tapering has got little influence here. I think that's probably just returning to the normal sales protocol. More interesting is I think what's happening down here. So this is when the stamp duty tax relief kicked in. The announcement was made on the 8th of July. But if we look, you know, the recovery actually started well before that. And not only that, the shape of the curve was not influenced after that point. And I just look at that and think, well, you know, what's that all about? Bear in mind, these are sales transactions. So the decision to buy, in other words, the confidence factor, was made even before that time. And the fact that there's very little difference in the shape there, and this curve here, if you remember, looked in terms of pattern similar to the previous pre-pandemic period. My view is, and I don't think it's universal, but my view is actually the fiscal matters in terms of the stimulus had little effect. I don't think the stamp duty relief had little effect in the sales transactions. Now, we're not talking about price, we look at that, but in terms of transactions. And actually what supports that is two things. First of all, Alex's data. Alex done that survey. It was all about moving. It was all about bigger space. It was all about consolidating people's position in their home. And to support my view on that, I'm also thinking back again to the Lehman's property crash, 2007, because the market plummeted there, and a lot of housing associations had a lot of shared ownership stock that they were struggling to sell. The then HCA were granting 10-year changes, bouncing from shared ownership to social rent, and in some cases were giving out grants to do that. It was a difficult time. The organisation I work for, we were struggling a bit at first, but what we did, we done some focus groups. We started talking to people. We wanted to know what was the issue behind the confidence. And actually, what we found out, it was not a fiscal issue. It was worries. It was fear, and there was two big things. First of all, people were seeing that property prices are dropping, and they were anxious about negative equity. And when we talk deeper about it, it wasn't the actual money side, because they thought, well, actually, I'm going to do one or two things. I'm either going to buy more shares, so it's great if property prices are cheaper, or I'm going to buy a bigger house on the open market, so it's great if property prices are cheaper. And so it wasn't the money aspect; it was actually the whole fear, this issue about being stuck in your home. The other thing people worried about was obviously losing their jobs and then getting their home repossessed. So as soon as we put in mitigations to the shared ownership product that took those two elements off the radar, so they weren't going to be an issue, it was like a light switch. We were selling off plan. It was almost like business as usual. So while there are other housing associations running off to get 10-year changes from the HCA, we were just selling off plan our shared ownership stock. We didn't swap any. So I'm thinking that actually the introduction of the stamp duty tax relief doesn't have much effect on the actual number of transactions. Now, I think Alex's data might support that in terms of why people chose to move. I think it's a personal view. But if you remember, at the beginning, I said we had an outlier view, and I'm going to look at that now. Let's go back to that graph. Linda Story from Pennington's was on the panel, and she said that actually she did not think there'd be a U-shape or a V-shaped recovery. She said she thought it would be more like a W shape, up and down, up and down, up and down. And I think that's where stamp duty has had an effect. And I think actually Linda busted the shape. She was the one that won the prize, because I think you see got a serif W shape. And so when she emailed me last night to say she wasn't able to attend the panel, I did say that she'd won the car, Andrew, and you'd be delivering it to her shortly. Okay, so finally, I want to take a quick look at house price index.
You didn't tell her how big the car was.
I just said it was a Tesla S. That's right. I remember you said we couldn't have a foreign holiday because it was a lockdown, so you were going to.
Oh, is that what it was? Okay, yeah.
Shame, because I could have done with a new car, but I think Linda got it right and I got it wrong. Although it was more of a V-shaped recovery than perhaps the U. Now, looking at prices, house price, and what I've done here is I've just taken a couple of elements out of the nationwide Q3 report. That line there is the pandemic. And you can see there was a little bit of an uptick just as we approached that, but it went bananas. And this is something Alex pointed out in his data during the pandemic times. And this is quite a paradox, because the world was absolute calamity, and yet normally when that happens, confidence kicks in and markets drop. It's not happening here, which again is why I don't think it's a fiscal issue that's influencing it. But I'm going to make a possible exception. Now, Bertrand Russell, one of the forefathers of critical thinking, said we should be flexible in our views and flex and change as the evidence comes in, and not look for evidence to reinforce our own views. I'm going to do the opposite here. I'm going to look at evidence to support my view. Here's the annual price changes. If you say, we're looking at 10 to 12 weeks, maybe a little bit more, a little bit less for transactions to take place and want to kick off. What we can see here, June 20 is when the tax relief, stamp duty relief announcement was made. Prior to that, things were flat. The the announcement was made, it dipped down a bit, and then it started, oh, what's happened here? Oh, bear with. I clicked on the wrong thing here, current slide. Here we go. And then it started to pick up like crazy, and we see that here. And then in June 21, stamp duty relief comes to an end and it flattens off. It'd be interesting to know what happens here. So my view is, although I was, waving the flag for the local lab when he made the announcement, Ricky said that comes from my hometown. Actually, my personal view is that the stamp duty relief didn't help on confidence. It wasn't an influence here, but unfortunately, it may have contributed to those price rises. And of course, in our sector, price rises are not good. HPI above regular inflation is a bad thing, because people had more money in their pockets to spend on their home. You see, as soon as it comes to an end, prices started to drop. So as people were making offers in the run up to it, they knew they were going to hit the deadline. So the offers maybe dropped down a bit there. So that's my take on it. It's a personal take, and lies, damn lies, statistics. We can basically twist and bend these things, interpret them as we see fit. But overall, I would say as a marketeer, if you're struggling, don't necessarily look at the fiscal matters, in other words, price cuts to try and get your products moving. Look at some of the softer things. And the two mitigants we put in the Lehman's thing is, one was on the negative equity side. We said to people, okay, you stay with us for 5 years. If at that time your house is worth less than you bought for, we would give you some of our shares free. So what you sell it for will be the same. Now, that might seem reckless, but if you do the number crunching, if people are staying there for 5 years, it was quite a safe mitigant. And the other thing we said was, okay, I understand you're worried about losing your job, but don't worry about it, because if you lose your job anytime in the next 2 years, your rent and mortgage is covered for 12 months to help you get back on your feet. Basically, we took out an insurance policy. And those two measures were what triggered the confidence back on again. So that's my view on what happened in the market over the pandemic period. And congrats to Linda for winning the Tesla.
Yeah, and Andrew will be delivering his company car himself. I'll tell Linda that later.
I'm trying to come off share, stop share.
Right.
This is turns a different way than I expected. Thanks for that, Greg. That's very interesting. That's a very interesting review, apart from the Tesla part.
Right, so now I have the great pleasure of introducing Becky Utuka from Gateway Housing Association, and Becky is going to give us a comprehensive rundown of her strategy right now. So thank you very much for joining us, Becky.
Thank you, Chris, and thanks to the other panelists for setting out the data. I'll follow with what's actually happening on the ground. So for those of you who don't know Gateway Housing, we're based in East London. We're a small housing association, have been around for 100 years or so, nearly 100 years. So pleasure to share with you what we're doing, but also I'll just touch on the national picture briefly, and then talk about Gateway's new build program. And also, I don't like to forget about existing shared owners who are also transacting with us. So I'll give you an overview of what's happening there as well. So Chris, if you can please help the slide. Okay, so with the national picture, as most of you will know, shared ownership is not actually a huge product. It makes up something like 1% of the property tenure right now. And in England, that's about 320,000 homes. So not a huge amount, but nonetheless makes a huge difference to some people. This is the only chance for them to get onto the property ladder, but that is a mixed picture, as you've heard from the media. For some, it's been great. For some, it's been a bit of a struggle, but it is a tenure that is going to stay with us for some time. I think part of the challenge has been knowledge about what shared ownership means, and we're trying to address that, as we go along. 50% of the new affordable housing program, which is funded by the government, is going to be shared ownership. So I think that sets a picture about where the government is going with this. It's not scaling back on shared ownership. They actually want more of it. And after 40 years of this product being around, you probably have heard that there have been some reforms trying to address some of the issues that haven't worked so well with the current model. So, for example, repairs. Some shared owners have raised concerns about owning just a share, but taking on 100% of the repair responsibility, which the government has now addressed in the new model. So, a few changes to come very, very soon. The other shared equity product on the market is First Homes. It's new. This will be delivered mainly through Section 106 contracts. It's offering 30% plus discounts on the product. So all buyers might have to do is to buy 70% of the home. Local authorities, we've heard, some of them are hoping to give as much as 50% discount. So this type of product will be another option for buyers. For those who can afford more, maybe they would opt for this, but for those who can afford less, might still look at shared ownership, where you can buy in the near future as little as 10% for first tranche sale. So what are we currently doing at Gateway Housing on our new build program? Well, currently we've got 170 homes to sell, and mainly in 3 boroughs: Hackney, Tower Hamlets, and Newham. There will be more, but these are the homes that we know are ready and we are focusing on at this point. Out of that 170, 98 of them were launched for sale. We launched 2 sites in April this year and another 2 in June this year. And I think that and we've got 31 more to launch in November. So in total this year, we'll probably have about 129. And the data shared earlier really, correlates with what we're seeing. So within this short period, we've got 56% of all the homes either reserved or sold already. And the sales tranche, the average sales tranche that we are seeing is 40%. So people are trying to buy more where they can afford it, which means that they pay less rent on the equity that they don't own. We also provide sales and marketing consultancy services at Gateway. So we don't only market our homes, we market homes for other smaller housing associations as well. And it's the same picture. Their data is not included in the 170 homes. We've also noticed a slowdown in enquiries, especially since the end of August, it's been coming down. And I actually have a meeting with our marketing consultants next week to discuss what the next strategy would be. So again, that confirms the data that has been shared with us earlier. If we could move to the next slide, please. So I thought this is interesting. I thought I'll share with you my perception of what I've seen, buyers ask for, the sort of behaviors or discussions happening. What's important to people is affordability. So we've got schemes in Hackney, which, as everyone knows, is a high value area. The sales values there are high. We've got 1-bed flats above 500,000. You go to East London, for example, Forest Gate, where we've got a site, and for that same amount of money, you can get a 3-bed flat. So affordability is important to some people, and they're picking and choosing locations based on that. The other thing is local connection. So people will opt for Hackney, although it's expensive, because of the local connection they've got there. Interestingly, finishes is a big thing. So again, I think that boils down maybe to affordability, where people are thinking, all right, in a Gateway home, I get X amount of things. I don't have to think about buying my white goods, or I don't have to think about that. Therefore, I'll opt for that option. So we're noticing that it's making a change. And also the amenities. So what have I got around me? Lifestyle, of course, is one. Interestingly enough, buyers are asking about snagging. So, is there a chip in the white good, in the bath or wash hand basin? Those sort of questions, and what aftercare services and support will I get if I were to spot a defect? What I personally think could be improved, and it's a concern for me, is that I'd love to see buyers discuss the quality of the product. not just the snags. So because of the whole building safety regulation due to come, Gateway has invested heavily in these homes ahead of that. So we've got sprinklers fitted, although the buildings are below 6-story. We've got fire doors, we've got 60-minute fire door compartmentations. A lot of investment has gone in to secure and safeguard these properties, because we know that the building regulation threshold will be lowered in future. Currently, it's at 6-story and 18 meters, but we understand that threshold has been set considering the capacity within the sector. As the capacity for the building safety inspectors and that increases and we get better, it is possible that that threshold will be lowered. So if I were a buyer today, I'd really want to have those discussions and understand them, and we're not seeing that come through. The other sort of questions we're getting is about service charges, rightly so, because of the media coverage of it. But what I'd love to see buyers talk more about is, what support will I get from you, Gateway, after I've bought my first tranche? Who will I go to? What services will be available? So I think for me, these are the two things that I'd really love to hear buyers discuss when they come to a sales agent, and we are encouraging those discussions. We can go to the next slide, please. So the other thing to look for if you want to be successful in selling in any type of tenure, as you know, is to plan ahead. And development appraisals are crucial, reason why we come to SDS, of course. And I've put caution, caution, caution. We've just been through a really volatile period during the market, as Alex and Greg have shared with us, and we're not through it yet. So how do you succeed in that kind of market? How are we still able to reserve? How are we able to achieve the sales values today? And it's caution, caution, caution. It's making sure that we're modeling this with risk in mind, especially since we're not out of the woodwork yet. And I think that is what Gateway has been able to do well. But also, some of the valuers who go into our property say to me, as feedback, wow, the finishes are good. Not only that, the quality is good. I think it's because for Gateway, we think about shared ownership as an investment for the business as well as the buyer. It's not just about selling the first tranche sale. These homes might come onto the market for resale. And at that point, you do want them to be appealing to whoever wants to buy them at that point. The organization must still own a share in them. So the quality of the product is really, really important to us. The other thing we've done, and I'm sure most organizations do, is the executive and board oversight over the sales risk. So these are things that we've discussed and we've rehearsed. We've got an exit strategy. My team and I know exactly what to do before we launch homes for sale. And if we don't trigger any of those exit strategy guidelines agreed with the board and execs, then we know that we are straight onto sales. So it's about rehearsing these things and not being surprised by valuation to say, oh, I think we're losing values here. You've got to have those parameters clearly set out and followed by the team. Risk management, Alex touched on that. He shared a SWOT analysis with us. The sales team do this every month. So we set time aside, have a risk workbook on every sales site, look at it. What are our competitors doing? It's really important. Are they giving any incentives or offering anything or doing anything different? And how might that affect us? But the other model we've got in-house, knowing that we're a smaller housing association and knowing that we are in the shadows of Canary Wharf and Hackney, where you've got all these high-end homes, is that who are we in competition with, and have we got the skills in-house to match that competition? And I think the answer is yes, we might, but we might not be as competitive as the private sector. So we've got a partnership where we bring in the consultant team, to support our in-house sales and marketing team. But the principle is it's a one team, and that's how we work. This ensures that we market at the sharp end. If you've gone to Instagram or wherever you find Gateway, you'll see a presence there. And that is to match the competition on the market. That's really, really important, as I think you all are aware of. So addressing some of the perception problems is important. When people walk through our show homes, they ask the agents all the time about this defects and things like that. But the commitment to change or improve that perception doesn't only sit with my team, it comes right from the top. So for the homes that we're currently selling, we've got a board task and finish group, which really means that one of the board members invites the buyers or tenants, whoever moves into our homes, after they've gone through their 28-day aftercare period, to tell them about their experience, to tell them about what they think about the quality of the homes. We also monitor the KPIs on defects. Where are things going wrong? And we want to be proactive. So if we notice that there are things going wrong on the windows, we don't want that KPI just to be multiplying. We want to address it now. And most often, even before people move in, make sure that that problem is catched. Because I think sometimes there's a disconnect between the sales team and the product. But I think the two need to go together. And that's what we've done. And I've talked about our aftercare service and the support that we give to our first-time buyers or our buyers is really important to us. So some of the things we're doing, for example, is that all the people buying their homes with Gateway for the first time this year will have a webinar with the sales and marketing team. One has already happened, and it's on our website. That was focused on existing buyers. But really is to catch people early and have an open dialogue about shared ownership, what they thought it was, where they are, what support they would need, and have a clear communication plan with them about how they, can improve their investment for going forward. So that those things are really important to us. We care about the product. Yes, we need the money, but I think caring about the product guarantees the money, and that is where our focus is. If we can go to the next slide, please. So, achieving the 100% home ownership aspiration is a mixed picture, as I said before. This is really looking at our existing shared owners. So people who bought from us last year, years before, what are we seeing? It's a concern because for some people, they came into this hoping to be 100% homeowners and they haven't been able to achieve the aspiration. And that's a concern for us, for those who can afford it. For some people might not be able to afford it right now. We do understand that. So the challenges we're seeing, as I'm sure you all know about, EWS1, so lenders looking at their risk profiles. So although the Secretary of State might be saying it's okay, you don't need the form, at the end of the day, the lenders, hold the pearls. And if it's a risk issue for them, then they won't lend. And we've been seeing some people have staircased successfully, others are having a challenge because of this. Affordability is a huge issue, and saleability as well. So for some shared owners who thought they could staircase, because of personal circumstances, haven't been able to do that, and it can be frustrating. The other thing we've seen is saleability, and I think this affects the whole sector. So where, for example, schemes in Hackney, high end, where, so expensive, people have bought it for good reasons, don't get me wrong, but might want to sell it, and the sales process is a bit slower because the values are high. So we need to continue to give these shared owners support to meet their home ownership aspirations, because at the end of the day, it's an affordable product. It is not an open market sale product. It is an affordable product. And I think personally, that's where sometimes housing associations have not done a lot, so we concentrate on the fair sales tranche, we sell it, people move in, and then we forget. We forget about the aspiration to own the home. We forget about the saleability. We forget about the affordability. There are currently no industry KPI benchmarks. So unlike our tenanted products, you've got the benchmarks on rents, you've got on repairs, a lot of KPIs benchmark on tenants, but there isn't a lot in the sector for shared owners. Yet shared owners are affordable, residents as well. They fall within that bracket. So my personal challenge to the sector is, where is the data? How can we know we're doing well, and where can we improve? There isn't a joined up thinking around data. Resources is another issue. So again, we focus a lot and we invest in a sales team for first tranche sale, go to the back office for resales, and the resources are struggling. But not only that, every shared owner would know that to staircase, it takes an army of people. You're not only speaking to the sales team, you need your service charge from the service charge team, you need to check your income from the finance teams, you need EWS information for property services, you need FRA, you need all sorts, in addition to the valuer and the solicitors you're dealing with. So I think all those backroom functions sometimes can be a struggle. And that's why shared ownership sometimes has that negative perception. I move on to transactional surveys. So again, comparing tenants to shared owners. So if you're a tenant across the sector and you have a repair done, you get a survey to say, how did that go? Well, how does that compare to shared owners? How are we speaking to them? So this is not an organization issue, it's a sector-wide issue that needs to be addressed. Communication between the professionals, I've already mentioned that. And I think that all of this boils down to that commercial focus we have at the beginning when we're selling the first tranche. We've got marketing budgets, we've got incentives. Well, compared to when you're a shared owner and you want to buy a sales tranche, what are we offering? So these are some of the challenges that our buyers have said to us. And I'll go on to what we're doing about it at Gateway if we move on to the next one. So EWS1, yeah, as I said, sometimes where buyers have come stuck and they have actually invested already, maybe paid the evaluation fee, we are reasonable where there's evidence, to give that money back, but also to be very upfront with buyers. So when people come to us, we say, well, we've had enquiries in this block and somebody, without giving the exact data because of GDPR, has staircase. So there's a precedence there for you. Where that's not happening, we need to be transparent to say, you might want to speak to your financial advisor because we haven't got a precedence yet. So be open with them, but also look at the affordability and saleability. And that is my challenge to my sales manager at the moment. So I'm saying, what are you doing or what are we doing for our buyers? And I know that there have been marketing campaigns where we've covered fees as an example, but I think there are things that we could do more to support that home ownership aspirations. The KPI is my personal battle. I take this conversation wherever I go, and I'm hoping that one day the sector can come together and have those benchmarks. And our back office and our sales team work very well. So every year we have a target of, based on the previous year, how much staircasing we think we're going to get so that we can plan for it. As I speak to you, the team have achieved 97% of the target already, and we're only 7 months or so down the line. And this is made possible by everybody in the organization understanding the role that they play. And I think that's part of our duty as managers and leaders. So for my repair colleagues, they understand that the income that's coming in from staircasing is contributing directly to improving the homes for our tenants. And so they see the benefits in there and can engage with everybody to get the process done quicker, which benefits the shared owner. And although we're not doing transactional surveys as an organization, the sales team have a survey, and that goes out after every sales transaction to see what we can learn. And of course, some people take the offer up, some don't. My role, I see, is opening up blockades, especially conversations between the consultants around the solicitors and valuers to speed things up. And I think as leaders, we need to show up, because if they don't see you, sometimes, we can get missing. And the only people who do not benefit is the shared owner. So part of my personal duty is to make sure that I'm showing up. The financial advisors know that I'm there, and we have a goal, and guys, this is going well, or ladies, this is not going well, and have those conversations and make time for them. For the resales, not just the first tranche sales, is important. And I think at Gateway, we have a commercial focus on shared ownership resales, and that's why we're doing well. So every year we have a marketing budget, not just for first tranche sales, but for resales. So looking at what incentives we can give, what support we can give shared owners so that we're supporting them to achieve their home ownership aspirations. And I think the more that we can do that as a sector, then we can begin changing the narrative of this very wonderful product, which at the moment, I'm afraid it is struggling. So I will end there, and thank you very much for listening to me.
You're on mute.
Apologies, right. Thank you, Becky. That was absolutely fantastic. First time presenter on our webinar, and I'm already getting comments that people are really enjoying it. You're a very good speaker. So thank you so much for joining us and giving us such a comprehensive rundown. It does appear to me that you are challenging everything that currently needs challenging. So, congratulations on that, and thank you for sharing your best practice. So now I'm going to open up for questions. So you've been watching. Have you got any questions? Please do let us know in the chat. And also, would you like to jump on as a panelist and have a talk? We've only got a few minutes left because we've had a lot of great talks today. Yes, any questions at the moment? Andrew, you usually got a lot to say. Do you want to kick us off?
Oh, thanks. Well, I think there was some interesting presentations there. I'm interested about this benchmarking and KPIs. I think that's one we've spoken a lot about that. Greg, we've spoken about that, haven't we? And it's maybe something for kind of Zoopla, Alex, to kind of see if we can. It's getting the data of what's happening on the ground. We've obviously had a benchmarking in appraisals and what we've done, but as the sector kind of moved away from that self-regulation as such, but it's a popular area on financial viability and what assumptions we're using, but it seems there's not much data kind of on the shared ownership sales on that side of information. I don't know if Alex or Greg can ask.
Yeah, I just said from my perspective, I mean, I've Andrew, that obviously I spent a lot of time at Home Track, which is part of the Zoopla business, and looked a lot at both the opportunities and challenges there are with data sometimes. And I think one challenge I've always found with certain sectors, and this isn't just in the shared ownership sector, but getting operators within that sector to share data and do it in a way that feels secure and safe, and make it kind of almost open source has always been a bit of a stumbling block. But we're doing some work at the moment around our Yorkies business around how we can actually look at some of the transaction side data that then informs a bit more about the sort of the after sales process as well, which I think is really important. I think what was a big part of what Becky was touching on, and I really like that approach to not just first tranche marketing budgets, but actually resale budgets, because too many times I've had RPs come to me and say, we're having issues promoting our resales, but we've got no budget to do so. What can you do for us, Zoopla? And we are a bit of a big commercial beast, and it's hard to help a business if they can't spend any money to do so. So it's great to hear that businesses are forward thinking about actually how do you support people in that onward aspiration to 100% ownership. That was really nice to see.
Brilliant, thank you. It's 11 o'clock. Yeah, it doesn't appear to be any further questions, and I think we will look to sign off. The recording of this webinar is going to be available on our website, and we're also going to follow up with the slides that you saw today. Thank you everyone for attending, and thank you indeed to our speakers, Alex Rose of Zoopla, Greg Warner-Harris, and Becky Utuka. You've all been absolutely fantastic, and we're very grateful for your contribution today.
Thanks, guys.
Excellent. We will be in touch again with our next webinar. Until then, have a great week.
Thank you.
Cheers, Cassie. Thanks, Chris.
Good.
Cheers, Becky.